Welcome, everyone, to another episode of Smokin Bulls, the podcast about business, money, and lifestyle. I'm Tyler.
I'm Dave.
And today we're joined by Lori Hartery from Desjardins Financial Insurance. We're going to chat with her today about executive health savings plans. So let's get into it. Lori, thanks very much for being here in the Smokin Bulls studios. We get to chat a bit about executive health savings plans today. But before we jump into that, maybe you can share with our viewers a bit about yourself, where you're from, and who you work with, and who
Absolutely.
you work
for. So thank you for the introduction. Thank you for inviting me to join you on your Smokin Bulls podcast. As mentioned, my name is Lori Hartery. I've been with Desjardins for 7 years now, but in the industry a little bit over 20 years. I know I'm dating myself. I started out in the industry as an advisor, working with clients and helping clients. Found my way more into the back end of things, working at a managing general agency for several years, 17 years, and then on to Desjardins as a wholesaler, helping advisors understand products, understand concepts, and how they could benefit their clients. And so the executive health plan, we've dropped the S, we've dropped the savings out of the, it used to be called EHSP. The S is now dropped. So EHP, Executive Health Plan. This is a strategy that we talk to advisors quite regularly. Desjardins is known for this strategy, but it's how it helps clients. I believe it resonates with advisors and with clients.
Right on. Well, thanks for that. I mean, we want to share with our viewers, I guess, who really fits in on this strategy to kind of narrow the audience down. So if you're talking about this executive health plan, and we're going to get into exactly what it is, who's your target audience? Who's the target market for this conversation?
Absolutely. So first and foremost, it's incorporated business owners, and generally small to medium size corporations, where the business owner, the shareholder, is vital as part of bringing in revenue into that corporation. But also it is a certain age category as well. Generally, the sweet spot is those in between the ages of 30 to 50 years old. This product can go up to age 60 years old, but after age 50, it may lose some of the attractiveness. Not always, but it may, and we can certainly get into that. But of course, healthy. It is critical illness insurance. And so generally the product is designed for those that have good health today, but worry about what will happen to their corporation if they become critically ill and they have to step away from their corporation. They want to make sure that the corporation can survive financially in the event of a critical illness, so that there's, something to come back to. That what they put that blood, sweat, and tears into building over however many years, that can survive in the event of a critical illness. So at its core, the executive health plan is a critical illness solution to protect the corporation. But there's part two of that. Business owners who are also looking for a tax mitigation strategy. They may have implemented other strategies, but they have more retained earnings and they don't know what to do with it. It's kind of just sitting in the business. That would be part two of the attractiveness of this plan, because in the event a client remains healthy, they would get back 100% of all the premiums that was paid into the executive health plan. Company would have paid the majority of those premiums. It's a way to move money tax efficiently out of the corp into their personal pocket, tax-free.
Right. And I think that's, that summary you've given there is something that's attracted Dave and I to the strategy. And as our clients and a lot of the viewers probably know, we work pretty deeply in the after-tax effects of not just investment planning, but insurance planning. And we've recognized that if we can work in that tax mitigation side and reduce that tax bill, we technically improve performance, improve a client's wealth or their position financially. So this strategy is something that Dave and I have used in our practice with other clients before. So thanks for kind of giving us that summary. Ultimately, it sounds like it's a critical illness first. Recognize that there's a risk there in your business that if you go down as one of the key employees or as the shareholder or owner of the corporation, if you're seriously ill or injured, your inability to work and bring in business and make sure that that business continues to function successfully is the real risk here. And then we can say, okay, we've got a risk that we need to cover. What are the ways that we can do it? And this health plan, this executive health plan is one of the ways, I guess, that they can explore tax mitigation options at the same time covering off a risk that they have.
Absolutely, absolutely. When it comes to corporations, if a business owner or a key employee was to become critically ill, expenses don't stop.
Mm-hmm.
Expenses don't care that they've just been diagnosed with a very serious illness. If they have staff still want to be paid, right? Corporate expenses, rent, mortgage, whatever it may be. Maybe they have contracts that they are obliged to fulfill that contract. But if you take them out of the picture, how do they fulfill that contract? And so at its core, it is a policy to protect the corporation. The attractiveness, though, ones that would perk up most business owners' ears, is the tax mitigation strategy, moving money effectively out of the corp into the personal pocket. Mm-hmm. But it does boil down to, is this contract set up appropriately? And we can certainly jump into what that setup and structure would look like.
Yeah, maybe just a little briefing on critical illness, what it is, critical illness insurance. I guess that a lot of people have heard of various different types of insurance, and I would say probably critical illness insurance is the one they know the least of. Mm-hmm. A lot of times people think they're covered because they have a long-term disability policy through work, things like that. So maybe let's just chat on that a little bit.
Absolutely. It's a great question, because in the industry we often talk about terminology and we don't really explain exactly what it is we're talking about. So thank you for bringing that up, Dave. Critical illness would be a lump sum payment to help a client financially when they're diagnosed with a critical illness. Now, the Desjardins contract covers 26 major illnesses. So things such as cancer, right? The Canadian Cancer Society will actually tell us that 1 out of every 2 Canadians will be diagnosed with cancer at some point in their life. But 75% of those diagnosed will survive. They may have gone through treatment for months or maybe even years on end, depending on the type of cancer that they had. And they survive, but it may devastate their finances financially while they're going through treatment. Mm-hmm. Cancer is just one of the 26. It does cover things such as heart attack, stroke, multiple sclerosis, bacterial meningitis, loss of independence, whether it's an accident or an illness that causes them to be unable to do some daily living activities. That as well.
I like that part of the coverage. The loss of independent existence makes it a bit more all-encompassing. You're not just listing off a bunch of illnesses that will be covered and then excluding a bunch of others. That loss of independent existence is one that I typically key in on with clients who are exploring that product and say, okay, well, if you're in a car accident and you become disabled, your loss of independent existence is now triggered. And that's when you can make a claim on the policy, which is then used for in-home nursing care, for example, or, whatever the costs might be, or supplementing your business expenses. Yeah. So sorry, I interrupted there, but that's a good one.
Absolutely. And Dave, you made a point about disability. Disability is a very important plan. It will cover accident and illness. It's not just any of the 26. It could be for any reason, but disability is really there to replace wage, replace income. And oftentimes only to a certain threshold as set out by the companies and by legislation. The critical illness policy is a lump sum payment to not only help with income replacement, but all those additional expenses that come up when someone is diagnosed with a critical illness. It may be covering a portion of income. It may be covering a portion of treatments that's not covered by Alberta Health. It could be that they want to fly to the Mayo Clinic to get treatment right away rather than waiting, being part of the number, right? Part of the Canadian health system. It can be used for any purpose, but really those unanticipated expenses that come up. But when we're specifically talking about corporations, disability coverage in the short term is really to protect the business owner's personal income, not so much there to protect the corporate income. So the executive health plan is there to protect the corporate income.
Right. So I think maybe a comment there would be around kind of shareholders when it's one person, one family. That might be easy if you have a partner that is not part of your family of the corporation, you want to be sure to document how the flow of something from a policy like this would go. Because technically once a payout or a claim is made and that it's paid out, it's paid to the corporation, and that technically would then be shared by the shareholders. So if it's supposed to go to the person who was ill, or at least be used for those types of expenses, I think something that you would have to put in a shareholders agreement between partners, even between family partners too, I guess. So just to throw it on that type of thing. So
absolutely, this type of strategy can work well for the single shareholder, but ideally it's when there's partners, because when one partner goes down, the other partner's taking 100% of the workload
That's
on.
right.
They may need help. They may need to hire outside the corporation. Last minute, they may need to pay premium dollar to hire someone to come in.
Right.
And so absolutely that tax-free benefit into the corp will be needed, but they do have to outline in a shareholder agreement. Desjardins will recommend that they have a legal document, a shareholder agreement drawn up to outline all the scenarios that you just mentioned.
Yep. Right.
Important to note, though, that the benefit is tax-free into the corporation, for the corporation to use those funds how it needs to use those funds in the event of a critical illness. If they do then flow it out as personal income or as a dividend payment, at that point, it would be considered taxable if they're going to flow it out of the corp into the personal cockpit.
Correct.
Gotcha. So it can be any amount of coverage. It doesn't have to be restricted in terms of the amount of the benefits. So that's a nice thing. I guess it's unique to that business and that business owner in terms of what they believe, and working with their advisors, what they determine to be the amount of cash injection that they might require at that time. So it's really basically, built around you, around what your need is going to be. So it's not restricted. Okay.
Absolutely. Now, there is some financial underwriting. So generally we say, as a starting point in the discussion, look at anywhere between 1 and 3 years gross business revenue as a way to determine what would the insurable risk be to the corporation if the business owner was away from 1 to 3 years. What is that loss of revenue? But you're absolutely right. It can be more than that. If it's a corporation that does have high debt, they can add more onto that to make sure it's an appropriate benefit, or less as well, if they are comfortable taking money from retained earnings in the event of a critical illness. So yes, it is tied to what are the needs of that particular client, that particular situation.
Gotcha. So I guess that maybe leads into our conversation around the other kind of bolt-on feature that these policies have. So you have your critical illness benefit amount, which is quite obvious. We need to, as we've discussed, cover off certain expenses and needs of the corporation. The bolt-on, I guess, that makes it a health plan, executive health plan, is this return of premium feature that you can add on. And we touched on it briefly at the start of the conversation. So maybe you can delve into how that works when you add that to a critical illness policy like this.
Absolutely. And so I think it's important first to know, how are we going to set up and structure this particular strategy? So it is a shared ownership, critical illness. The corporation and the shareholder will jointly own this contract. The core of the contract, as we just mentioned, is there to protect the corporation. So the corporation is essentially, at the end of the day, going to be the owner, the payer, and the beneficiary of the CI benefit. And there is a death benefit built into this contract as well. And that should be the lion's share of the premium. The business owner, the shareholder, is going to be the owner, the payer, and the beneficiary of the return of premium on cancellation. And we refer to that in the executive health plan as a health benefit. They remain healthy. They never have to make a claim because they are the beneficiary of that particular section of the contract. Once they get to year 15, that's the earliest they can exercise the return of premium, they will get 100% of all premiums paid. So what they are going to pay personally. So we do have to ensure that they are paying premiums. We want to keep this on side with the intent of the Income Tax Act. They have to have some skin in the game, and that is through a premium payment if they're going to be the beneficiary of that. So if in 15 years they've never made a claim, they will get back every penny that they've put in personally with after-tax personal dollars, plus every premium payment that the corporation put into the contract over that 15 years. And so it is a way then to effectively move money out of the corp through a premium payment into their personal pocket in the most tax efficient manner possible.
Okay. So the company is paying the premiums for the critical illness benefit. The executive or the owner of the company or shareholder is paying the premiums for the return of premium personally.
Yes.
Okay.
How is that structured for most entities? Do you find that the employee uses after-tax revenue to pay for the premiums, or do you find that the employer issues a T4 for that benefit?
Mm-hmm.
Is that the primary way you see it set up, or do you see two separate premium payments?
So there's the cleanest and best way it should be done, and then it's what we see.
Right.
Okay, so let me talk about the cleanest and best way to do it. The cleanest and best way to do it and not have to involve accountants is for the corporation to send an annual check for its portion, and then the business owner or the employee to send a personal check for their portion of the premium, send that off to make the annual premium each year. That's the cleanest way. But of course, checks are kind of gone the way of the dinosaur, right? And people are more instantaneous. If they want to pay it, they want to pay it now and see that it's been done. And so most often what we see is that they want a withdrawal to be made. Now, if they want a withdrawal to be made at Desjardins, we can only set up one payer. And when we set up one payer, we would generally recommend have the corporation pay the entire annual premium. In the event it's a business owner, what they would have to do then is at the end of the year, work with their accountant so that the accountant can attribute what portion did the corporation pay on behalf of the shareholder and have them attribute that at tax time. Usually it's a non-eligible dividend is how they'll record it. But again, every client's situation may be different. It will be up to the accountant to figure out the best and most appropriate tax efficient way to record that. If it's an employee, it would be added as a taxable benefit on a T4.
Right.
Yeah.
If the corporation paid the employee's portion.
Yeah.
Okay. Seems pretty straightforward to me.
Yeah. Let the accountants deal with it.
Yeah, that's right. I know some of the questions we often get when we start to discuss this with clients is how difficult is this coverage to get? Because we're talking about a health plan here. What's underwriting like? You know, is it difficult to get coverage? You mentioned kind of the target age groups of this age 30 to age 50. But is there I know there's underwriting, financial and health underwriting. Is it difficult to get critical illness insurance? It's different than life insurance that most people are accustomed to applying for. So is it any more difficult, or what's the experience like there?
I wouldn't say difficult, but the underwriting guidelines for critical illness can look and dig and scrutinize health a little bit more than what it would for life insurance, because we know at the end of the day, clients' health is important. We know, and the statistics, I'm having trouble saying that word, show us that most Canadians will be diagnosed with a critical illness at some point in their life. Death, of course, usually comes later in life, whereas critical illness, it can really strike at any particular age. So they do take a close look at a client's health. Now, that said, if a client does have a health challenge right now, depending on what that health challenge is, Tyler, this is the one product that if there is a health challenge and the client is rated, it actually benefits the client. Because at the end of the day, as long as the corporation can sustain an increased premium to the insurance company, what is considered rated for extra premium because there's a health challenge only applies to the corporate portion, not the personal portion of premium. And so in that scenario, if the client is banking on, I really like this protection, I see the need, but I think I'm going to remain healthy, this would allow them to get more money out of retained earnings from the corporation's premium portion tax efficiently into their personal pockets. So you're right. There is a little bit more,
stricter underwriting.
but we do an awful lot of these. And, even when there's health challenges, a contract still may be offered.
Well, that's why 30 to 45 is the primo age because you haven't been to your doctor much, so you don't know what's wrong with you and your parents.
They're still healthy.
They're still healthy. They might not have run into some of these critical family history, critical illnesses. So the younger you are, the less material that the underwriter has to work with.
Yeah.
So how much of a underwriting is your family history dictate on this?
It's family history is very important in the underwriting of critical illness, because oftentimes the particular critical illness, it can be genetically related. It can be one that tends to run in families if there's already a family history. And so cancer, for example, not all cancers are genetically related, but some of them, particularly breast cancer or ovarian cancer or colon cancer, tend to run in families. And that may be one where an offer can still be made, but perhaps we would exclude that particular cancer or offer a rating as well. It would be underwriter discretion on that one. So family history really does come into play, because certain illnesses will run in families due to genetics.
Is it better if you don't know one of your parents, or if you do? How does the underwriter handle that? We don't have one side, so we're going to say it's a clean health side, or we'll give it the average health side.
The underwriter will have to take a look at that if they don't know the health history. But hey, if they don't know the health history and everything is okay health-wise with the individual, the underwriter will have to take a look at the individual
for sure
versus the family history for sure.
And one would have to assume that since underwriting is more strict and we're talking about health issues and not death, that your claims experience is probably, more frequent. You're making more claims on a product like this. Is that right? Is that why it's generally more expensive and more difficult to get, is because there's more claims?
We know at the end of the day, this is likely the one product that our clients are going to need during their lifetime. And of course, critical illness can strike at any age. I myself know, I think, 8 people in the last 2 years, all under the age of 50, diagnosed with very serious illnesses. And generally, it was either an early cancer or it was cardiovascular related. This is the one we know they're going to need. And this is the one we know they're going to keep long term until they get to a certain point and they've never made a claim and they've got that return of premium. That's when they cancel and they can get that lump sum. So death is further out in our lifetime. A critical illness can really strike at any age.
Right. And I think that's the attractiveness of the product, is you think of insurance, and a lot of people sometimes have a negative view of insurance products, feel they're overinsured, they're buying insurance for everything. Cars, especially a business owner, has insurance in multiple facets depending on the industry that they're in. And so they're like, not another insurance product. But this is one that you kind of always get your money out of. It doesn't matter what the scenario is. I mean, heaven forbid you've got a critical illness. Well, that's a claim. So you get your payout. You make it to the end of the contract, we're at that 15-year mark where you say, well, hey, I've stayed healthy like I thought I would. I get all my money back now. Even if you die during that contract period, there's a death benefit where I think is it all of your premiums that are then received back? So the corporation would then get the return of premiums, or the premiums returned on a death benefit in that case. Is that right?
Yes, or more. In fact. So with the Desjardins contract, the death benefit would be 25% of that CI, that critical illness benefit, or all premiums paid, whichever is larger, whichever is greater. So
you're always getting your money out of this product. Like it's a never lose.
It's a win-win.
Yeah.
It's a win-win.
Yeah, and
product.
Insurance does have that negative connotation, because for the most part, you're buying insurance because something crappy has happened, and that means it's not a good thing. It's not like the young person who buys $1 million life insurance policy and brags to their friends they're worth $1 million. You're worth $1 million dead, and someone else is partying on your money. This, as Tyler's saying, you do have the sense that money can come back to you to take care of something while you're still alive that could still result in a betterment of your situation, whether it's even as a critical illness payout. You might beat this and you might still have some of that asset left over, or you don't get anything and you get the refund of premium in a tax efficient manner. So I think that's the upside to this, that sometimes, for those people who really look at insurance in a negative way, this would be something that has a lot more positives than negatives. I mean, if you imagine they could sell car insurance and say, if you don't have any claims in 15 years, we're going to give you X amount of your premium
Wouldn't that
back.
be
I think in
great?
the States, there's some companies that do that. Now would that make better drivers? Would you make different decisions because you want to get some of that money back? I know they have the in-car things, which tracks your driving habits and you can get a reduced premium for it. But nobody ever feels like they're really getting anything reduced. It's just premiums keep going up. So if you're getting your money back, that's a different thing altogether. So that's enough of a sidebar there. If we go into, say, strategies, and this is strategy, say, from Tyler and my side, when we're talking to clients, obviously we're talking about the tax efficiency, we're talking about the need inside the corporation. One of the things and you can clarify if this is, a good approach. Obviously, DNA is not used in the underwriting because it's excluded under government regulations. So, and when I'm talking DNA, I'm not talking 23andMe. I'm talking, the full blown where you get a voluminous book that basically tells you what you're going to die from. Mm-hmm. Somebody gets that done could be very well aware of, potentially what could get them at whatever point in life. That should be something that person should be then moving on to looking at a CI policy because they're in possession of some information that is important. That the person who never got those tests done might not be aware of. Mm-hmm. So I think that's, for us, we would push clients to get those tests if they're really interested in these types of things and to use that effectively to move forward with a critical illness policy. Because lots of people just have this belief, nothing bad's going to happen to me. And so we would be going at it from a pure tax efficiency point of view. But that's not always the case. I think it's some people don't want to know, some people do want to know. If you want to know, find out. Type thing. So what's your take on that process?
Mm-hmm. So you're absolutely right. The insurance company cannot look at or use those results, whether they're good or bad, right? Legislation prevents us from doing that. And that can be a good thing for clients. Mm-hmm. And so I would say absolutely, get those tests done. Find out, is there something that's within my genetics that maybe if I eat healthier or I exercise more, I have a better odds of, making sure I don't have that particular illness. If they do have a discussion with their doctor, though, and now it's on their medical records,
that's right.
Whole different ballgame, for the insurance.
And how do you get those DNA tests? Through your doctor.
That I did not know.
Well, I think to get this, I think it's in Canada, unless you're going online and getting a full-blown one done around that. A lot of the doctor's offices now here would be the resellers of some of these products. So I think they end up with a copy. So that could be a concern for somebody as to who has the data.
Could
right?
be.
If you have that discussion, like you said, once it's in your medical records, that's open season then.
If they find something and there is a discussion with the doctor, the fact that they ordered a DNA test isn't going to ruffle any feathers at the insurance company. But if they do find something in the DNA test and now there's a discussion with the doctor, then that would be information given to the insurance company.
Yeah, we did. I think that was our second podcast. We had a geneticist.
Oh.
And he was quite interesting on these type of things. He's like, well, basically 23andMe is maybe 1% of your DNA is analyzed. Okay. He goes, the other 99 is the crazy stuff. And there was quite the discussion about how they can use your DNA, and that there's lots of countries who are implementing some of this, but he was a believer that at some point in Canada's future, you just get DNA'd from birth. Yeah.
Okay.
And, as you're going along your life, you meet somebody, it might be, let's see here, let's just send both those in. You know what? Sorry, we can't. Our offspring might not make it. There's all sorts of use of the DNA. And so it's interesting in this format, but it's good information to have. Yeah. Without sharing with your doctor.
So obviously this has been a conversation geared toward the business owner. If any viewers have stayed on that aren't business owners, it should be aware that they can get return of premium on a regular critical illness policy as well. Absolutely. There's just not that tax efficiency that might occur in the future of removing potential corporate assets out of the company and into your personal hands. But as an individual, you can buy critical illness, add return of premium to it, and get 100% of your premiums back as well. In the future. So
we've done the math. Sometimes it is tax efficient. The easiest way to calculate something like that is what do I have to get from an after-tax rate of return on a non-registered investment to equal the value of this policy. And so that's good math to know. Now, once you start using a TFSA it becomes harder to price it properly or to get the right effect from it. But I don't see why anybody, once again, this is the opportunity to have some insurance where you get something back, whether you don't have that
Make a claim
event. Yeah. I mean, this is good from an insurance point of view.
Mm-hmm.
You're giving up some time value of money for covering a risk and getting something back. So,
right.
Yeah.
Absolutely. And it can be used as a way to ensure a client's retirement as well. If they find themselves, they're diagnosed with a critical illness and they need huge, large lump sums of money to pay for some of the treatments that they're going to need. Now in Canada, we're fortunate, right, with our medical system that a lot of those treatments are covered, but not every single treatment as part of that treatment plan is covered. They could be thousands of dollars out of pocket. Where does that money come from?
And not in an immediate way either sometimes. I mean, if you look at the news, I mean, just read the news now, and I think the backlog is getting to the point where some people are not surviving some of these things that maybe if they addressed it quickly, they might have had a better chance. And so not advocating that everybody gets this and hops on a plane and goes somewhere, but you're 100% correct. This is, we always used to say, look, if you end up with a situation and you get the money and it helps you survive it, well, then your retirement money is intact.
Exactly.
If you burn through all that money and don't survive it, the retirement money is still intact for other family members who were depending on it. So the worst thing would be to beat something, but have to go back to work for another 5-10 years to try and build that money up.
Absolutely.
And the second thing would be if you're not going to beat it and it's a known thing, but you survive it for 30 days, as per most policies, there's that 1 month trip for the whole family to Hawaii. There's things that people would use this money for that aren't going to be a detriment to the family finances after the fact.
Absolutely.
So I think that's a good reason to have something like this, because it's something that you might be able to enjoy or take good use of while you're alive. And I think we've talked a lot about that. Because of life insurance, you're gone. There is no financial benefit to life insurance to the person who's deceased, other than leaving a better situation behind from a tax perspective and a estate perspective.
Yeah. This is good stuff, Lori. Is there anything that we haven't touched on in regards to this type of setup, this strategy, that maybe our viewers should be aware of, or have we covered all the topics that we think we have here?
I believe Dave, Tyler, very, very well-versed in this particular strategy. So I believe you did hit on all the major points. But just to really elaborate, this is a win-win scenario to protect, in this particular strategy, the executive health plan, to protect the client's corporation, but to help them move money tax efficiently to their corp in the event they remain healthy. And we're at a time where corporations are being taxed, right? The capital gains inclusion rate had just gone up. And so there may be further discussion on how much tax it's saving, but I do think this is one of relevance and a timely conversation for business owners of any occupation, of any profession. Generally, where we see tremendous success with this particular strategy is in the medical community, the dental community, the veterinarian community, but it can apply to any corporation. It can be a single man, single woman electrical shop or plumbing shop. It can be the IT consultant. It really can apply to any industry where the business owner is vital as part of the success of that business.
Right.
Yeah, I think, it's like Tyler said at the start, one of the strategies that we use, that we advise our clients on, a lot of clients, they want to save tax, but they're looking for, well, how do you get me $100,000 back this year? Well, it's very hard to do that. You have to implement a suite of strategies to really make a dent and to really make a difference many years down the road. And there is no one quick fix to people's tax situation. And all of these are little chunks that add up to a lot of money over the years. And I think that's what we try to make our clients aware of, that there's no quick fix. You have to have a strategy. You have to plan further out. You look at the ideal age for this CI. It's in the growing period of someone's life, is the ultimate, keeps premiums low as well. But, once they implement this with a suite of different strategies, it can make a difference financially and tax-wise, and tax-wise being kind of what we specialize in overall.
Absolutely. And if I could just clarify on one point, the sweet spot when we're talking split of premium is really those in between the ages of 30 and 50. We can go as high or as old as age 60. It just means the premium split is going to be a little different.
A little weaker.
Depends. It depends on the age and, of course, the smoking status as well. But it can still be very attractive and very much needed, even for clients that are older than age 50.
Nice.
Right on. Okay, well, I think we've hit on all the major points, Lori. There's a lot to cover, and obviously this is something that you guys who are watching need to have conversations with your advisors and the team that's surrounding you. If you need more information on this product or this strategy, you can certainly find us online. But thanks again for watching. Make sure you like and subscribe and check us out on all of our socials. Lori, thanks very much for being here. We'll hope to have you again to talk about some other strategies. And thank you all for watching. Bye for now.